Hey everyone, good afternoon. Thanks so much for joining us for Bankrate's webinar on COVID-19 and your money. Today we're going to be digging into how the broader economy has been impacted by the pandemic and what recovery might look like, how to keep your money safe, and what the home buying and refinancing landscape currently looks like. To bring us that insight, we're joined by Bankrate's Greg McBride, Chief Financial Analyst and CFA. Greg, how are you doing?
I'm great, Lance. Thanks so much. Appreciate it. Appreciate you doing this.
You bet, and same to you. Greg, you have nearly a quarter century of experience as a personal finance expert, and you've appeared on countless media outlets talking about the topics we'll discuss today. So I think you're the perfect person to go through these topics. A little bit for the audience, how this is going to work. For those who are joining their first Zoom webinar, you are all on mute. But if you do have any questions, do me a favor and find that Q&A section of your Zoom screen. You can find that at the bottom of the Zoom screen. You can type questions in and send them to me. I'm going to be monitoring them in the background, and hopefully we'll have a chance to answer them in the live Q&A portion at the end of the webinar. So please do submit your questions as we go through the topics today. And lastly, we'll be emailing a recording of this webinar to you after it's completed. So if you do miss something, no problem. You'll be able to go back and watch the entire thing. Greg, I hope today that we share an overview of what's going on so people can take that information and adjust their finances accordingly. To start off, I do want to get just a general sense of where we're at with the broader economy. Can you give us the context there? And the first question has to deal with unemployment. Last Friday, we had the dismal April jobs report, 20.5 million jobs lost, the largest drop on record. Unemployment rate spiked to 14.7%, highest since the Great Depression. Help us wrap our heads around what we're dealing here with unemployment.
Well, the word unprecedented has been used a lot lately, and with good reason. I mean, it's traditionally when the economy goes into recession, it's kind of a long, slow slide into recession. And what we've seen this time is just a sudden stop, literally turn off the lights, everybody go home. And so we've gone from an environment where the economy was entering the 11th year of its expansion. Unemployment was at a 50-year low. We're now at the highest unemployment since the Great Depression. So the lowest unemployment in 50 years, to the highest in 90 years. And we did the lion's share of that in about 7 weeks' time. So yeah, and as bad as those numbers were from the employment report last week, which you noted, the 14.7% unemployment, even the employment report itself admitted to some of their estimation difficulties because of the pandemic, thinking that they probably underestimated that by a full 5 percentage points. And so the reality of it is, for all intents and purposes, unemployment's actually over 20%. And just this morning, we saw another nearly 3 million unemployment claim filings for the past week.
So the next question has to deal with the economy shrinking. We saw U.S. GDP fall 4.8% in the first quarter, the worst quarter since 2008. What are the important takeaways from this report for individual consumers to understand?
A couple of things I want to point out. I mean, first, I think it just kind of shows the severity of this, in that the economy really didn't shut down until mid-March generally, right? So out of a 3-month quarter, the first 2.5 months were more or less normal, right? And it was only the last 2 weeks where, we shut everything down and told everybody to go home. And that was enough to drag the economy to, as you noted, Lance, the sharpest drop in economic output. And so, and yet, Q2 is the one that's going to be the big one, right? That's going to be the one that's really bad, because we've been basically in economic lockdown the whole way through. I do want to add a little context to the numbers themselves. That 4.8% from the first quarter, those numbers are given on an annualized basis. And what that means is, it's basically, the economy didn't shrink 4.8% in the first quarter. Now, it shrank about 1.2%, but 4.8 at an annualized pace. If it had kept up that pace, it would shrunk at 4.8%. And the reason I point this out, I'm not trying to sugarcoat over anything at all. I think the context is important, because at the end of July, when we get that first look at second quarter GDP, the number's going to knock you off your chair. And, there's going to be all kind of doomsday headlines, because everybody's expecting the number to be down 25, 30, 40%, something like that. The economy's not going to shrink 25, 30, 35, 40% in the second quarter. That's just an annualized pace. Now, make no mistake, economy's still going to shrink 7, 8, 9, 10%, which on an annualized basis is going to give us that really shocking, ugly number. But I think that context is important. It's like, if Mike Trout hits 2 home runs on opening day, at an annualized pace, he's on pace for 324 home runs. Mike Trout, as great as he is, he's not going to hit 324 home runs in a season, right? So, kind of that same context with regard to economic growth. It's bad. It'll be a bad number, but basically divide by 4 with whatever number is in the headline.
Got it. So we've seen a number of responses from the government and the Federal Reserve to help prop up the economy and the individual consumer. Good example of that would be the stimulus checks. What do you make of what's been done so far, and what else can be done?
I think the one takeaway, at least on the Federal Reserve side of things, from 2008 was don't wade into the pool, jump into the deep end and make a big splash. And so that's really what we've seen. I mean, they very quickly rolled out a lot of the alphabet soup of different liquidity programs that they had in 2008. They have continually expanded and innovated on that and brought new programs to market as need be. When credit markets started to tighten up the second week of March, the Fed was on the case and on the case quickly. And the importance of that cannot be underestimated. The cutting interest rates to zero, where that really pays dividends is when we're in recovery mode. Having that backdrop of low interest rates will help whenever we're at a point where confidence is starting to come back, where people feel more secure in their jobs. Right now it's of limited help, right? I mean, somebody who's worried about losing their job is not going to go out and buy a new car just because rates are low, right? But you get 5-6 months down the road and things are opening up, people feel more confident. Having that backdrop of low interest rates is going to propel, I think, a lot of business and consumer borrowing and spending that we're going to need to reflate the economy.
On a more positive note, I want to talk about the potential recovery. We've heard a lot of predictions about what that recovery could look like. Is it V-shaped? Is it U-shaped? A lot of letters thrown out there. Is it a Nike swoosh? Greg, what do you think the recovery timeline looks like?
Well, I've got a new letter for you. It's W. And so the way that, I think that shapes out, W being sharp drop, what we've seen. And then, we do get sort of a snapback, a minor snapback as things reopen, people get recalled from work or to work from the furloughs. But then at that point, the economy is going to have to stand on its own 2 feet. And the reality of it is that, like you look at airlines, for example, part of the CARES Act, them taking government money, was they pledged they weren't going to lay anybody off till October. They're already saying they're going to lay people off in October, right? And so I think a lot of businesses, may be in that same position where as things reopen, it's okay, great, we're back to business, call people back. But then if the demand is not there, then they're going to be in a position where they're having to downsize, right? And so I think that's that sort of second leg down in the W before we then get a more sustained rebound in 2021 largely.
So switching gears a little bit, I want to talk about savings and how our audience can keep their money safe. Greg, one thing we always stress at Bankrate is the importance of an emergency fund. What role does that emergency fund play in this type of environment? And what should people do if they currently don't have a fully funded emergency fund built up?
Well, your emergency fund is going to be your go-to in an environment like this if you have suffered any type of income disruption or financial hardship. The old saying, save for a rainy day. If you've lost your job, if you've been furloughed, if you've had your hours drastically cut back, if you've had to care for a sick relative, it's raining, right? That's what it's there for. And frankly, this proves that it works, right? Because that emergency savings account is going to be the buffer between you and high interest rate debt for, that's the unplanned, the unexpected. We do see in a poll that Bankrate released this week, 30% of households say that they've seen a decline in income just because of the pandemic. And those households that saw their income go down were 3 times as likely to have tapped their emergency savings since the outbreak of the virus. So, that's why you have it. And for those that are still working, and this is a great time to have that cushion, whether it's your annual tax refund, stimulus check that you got, the money that's not being spent dining out going to movies, concerts, ball games, funnel that into savings. Pad that cushion, just because frankly, nobody really knows what lies ahead, and nothing's going to help you sleep better at night and knowing you've got some money tucked away.
Absolutely. We've gotten a lot of reader questions at Bankrate over the past few weeks asking, how do I keep my money safe? It's a simple question with a number of more complicated answers, but let me start here. What's the easiest way for someone to keep their savings safe, and where do you recommend people put their savings?
Well, let's start at the most basic level. Your money is safer in the bank than out of it. In the early stages of, the economic shutdown, we saw people rushing to the ATM to withdraw cash in large sums. And frankly, I just don't get it. This is not a natural disaster like a hurricane or an earthquake where, the electricity's out for an extended period of time, your payment systems can't function, and you truly do go to a more cash-based economy. That's not what this is. Other than, maybe, paying people in cash, I really don't understand the rationale behind that. Your money is safer in the bank than out of it. Now, within the bank, where do you put it? Having that liquid savings account for that emergency fund is really the place to be, and specifically online savings accounts. The average bank right now is paying about 0.1%. The other alternatives are pretty much in the same boat. Money market mutual funds are in the same neighborhood and moving lower. Government debt, Treasuries are pretty close to zero, but online savings accounts still about 1.5%. Yeah, they may come down a little bit more, but you're still going to be 10, 15-fold better than your alternatives. And you don't have to upend your everyday banking arrangement. You can just link it to the checking account you have at your current bank, seamlessly move money back.
Got it. Yeah, we've got a number of viewer questions and some related to this subject matter, so I want to work those in now. One of the viewers asked, I read the advice of an economist who said that given the dire events occurring now, it is no longer safe to place money in FDIC insured CDs, and that the only true safe place is Treasuries. Greg, what are your thoughts?
I disagree with that completely. Nobody has ever lost a dime of federally insured money. So if you're putting your money in a bank, make sure it's FDIC insured. If you're putting your money in a credit union, make sure it's insured by the NCUA, which is the National Credit Union Administration Share Insurance Fund. And if that's the case, you're fully protected.
Another viewer points out that FDIC only insures up to $250,000. Greg, any additional thoughts on, like, if you exceed that number, how to spread your money around?
Yeah, keeping that limit in mind is absolutely critical if you're fortunate enough to be in a position where you've got that kind of money. Yes, you absolutely want to stay under that limit, including your interest earnings, because you don't want to expose yourself to any kind of loss. I mentioned nobody's ever lost a dime of federally insured money, but that's, assumes they were under the limit. The money that was over the limit, that could be lost in a bank failure. It's not worth exposing yourself to that. There are plenty of other banks that offer attractive returns. Spread the money around. If you really want it under one roof, you can title accounts differently in order to up that insurance coverage. But bottom line is there is no reason to have money exposed by exceeding the federal deposit insurance limits.
We also got a related question from Karen earlier in the week. She says she has 2 checking accounts, one in FDIC bank and one at a credit union. She doesn't know if she's doing the right thing or not and which place is the safest. So how do credit unions factor into this insurance?
From a safety standpoint, as long as that credit union is insured by the National Credit Union Share Insurance Fund, that's the same as FDIC insurance. It's the credit union equivalent of federal deposit insurance for banks. So from a safety standpoint, Karen, I think you're good to go. The only question I would have is, the 2 checking accounts thing. Look, if it works for you, great. I think for some people, it might make, sort of managing monthly expenses a little more difficult, kind of having, 2 different pots of money, maybe consolidate that into one. But, if you're shopping around and getting the best yields on your CDs, you've got your money in federally insured accounts, I think you're certainly, from a safety standpoint, you're not exposing yourself to any loss.
So we've got the savings side taken care of. Another part of the is my money safe question. A lot of people looking at their investments. Should I get out of the market now as it's going down, or is this an opportunity to buy the dip? Generally speaking, how should someone approach investing right now?
Now more than ever, people need to maintain their long-term perspective. And we've seen a lot of volatility in the markets. Market fell 34% from mid-February to about mid-March. It then rebounded 30%, gaining back a lot of that lost ground. And it's shown more volatility this week, right? So the old adage is time in the market, not timing the market. In other words, don't try to jump in and jump out, try to time it. Think long-term, stay true to your time horizon, your long-term goals. I like buying things on sale. So when you see a dip in the market, yes, it's a good buying opportunity. But not this jumping in, jumping out, because to do that requires two things. One, you got to not only know when it is time to get out, but you also got to know when to get back in. And frankly, to get both of those right, just not going to happen. Particularly when you consider that a lot of the market's best days come on the heels of its worst days. So again, time in the market, not timing the market.
Got it. And Greg, I'm just monitoring some of the more of the questions we're getting from the viewers. Another person writes in asking, what is the best advice where to put my savings during this time? Should I look at bonds in the stock market or elsewhere?
Time horizon is ultimately what's going to determine the answer to that question. I mean, if this is money that you need short term for your emergency fund, then it needs to be in something like an online savings account where it's liquid, you can get to it and there's no risk of loss. If your time horizon is longer, this is money that you're not going to need for a few more years, then you can afford to take a little bit more risk. I mean, if this is money you're not going to need for 5 years or so, maybe look at some intermediate term bonds where, yes, you're going to take a little bit more risk to get a little bit higher return. If you've got a long time horizon, if this is money you're not going to touch for more than 10 years, the stock market is really the best place for that money to be. You can buy a total stock market index fund and really diversify your money really from the first dollar you invest.
Okay, monitoring these questions, trying to track down one I had my eye on. So yeah, here we go. So a viewer asked about reallocation and just rebalancing a portfolio. I guess, that's just good practice overall as you're investing. Does it take added importance as the market has kind of, been so volatile lately?
A lot of times, and this kind of goes back to the earlier question about people like, oh, should I get in? Should I get out? That kind of thing. Oftentimes the best thing to do is nothing, right? If your time horizon hasn't changed, just kind of continue to maintain that long-term perspective. The one thing I say is, well, look, if you're really itching to do something, then just take a look at your account and see what your allocation is now relative to what it was at the beginning of the year. Because of the volatility in the stock market and the fact that bonds have done well, it may have thrown that out of whack. And so rebalancing back to your intended investment mix, it forces the discipline of buying low and selling high and kind of keeps you, on track for your long-term goals.
Got it. And Greg, we've gotten a few questions on CDs versus savings. I guess if you have a little bit extra that you're just looking to stash, how do you kind of decide the savings versus CDs question?
Well, for most people, you need the money liquid in a savings account. Now, you can certainly supplement that. If you've got a fully funded emergency savings account, you can certainly supplement that with some CDs. You just want to be mindful of the fact that there's an early withdrawal penalty if you have to cash prior to maturity. So you want to align your time horizon with the CD that you pick. There are some no penalty CDs out there, or those that have really low early withdrawal penalties. They give you an opportunity to arbitrage it a little bit. In other words, you get the benefits of a CD in that you're locking in your rate, but that you can pull the emergency exit and get out easily. So that's certainly a consideration too. But first and foremost is you need liquidity, you need access to the money for those unplanned expenses. Don't compromise that. Okay,
great. I have two questions on this topic, and then we'll move on to mortgages and refinancing before circling back to the Q&A. Kathy Burns is watching, and she asks, are online banks that are FDIC insured, of any risk versus brick and mortar banks that are FDIC insured? So online banks, brick and mortar banks that are FDIC insured, are they covered the same way?
Yeah, it's the same FDIC insurance. They're regulated the same as the bank down the street. And in fact, in a lot of cases, these online banks, they may be the online banking division of a brick and mortar bank in another part of the country. But the key there is the FDIC insurance. Make sure that whoever you're putting your money with is federally insured.
Got it. And last one before we move on to home buying. Brian wrote in earlier this week, now that the Fed has reduced rates to near zero, there's a race among online banks to reduce the APYs on their savings and CDs. How do I, as a retired person, minimize the loss of income of my deposits and savings and money market accounts?
Well, there is kind of this sort of whack-a-mole temptation to play whack-a-mole and moving it from this account to that account. But listen, rates are falling. And so, they're all kind of coming down. And so, moving from this account that's now at 1.25 over to this one because it's at 1.5, by the time you get your money there, they might be at 1.25, right? Mm-hmm. So, I think there's limited benefit to that unless you've, really got a lot of money and, can benefit from moving it back and forth. But the bottom line to me is it's not so much whether your money is at this bank paying 1.5 or that one paying 1.25 as much as if you've got your money someplace where it's earning 0.1% or 0.01%, and most people do because that's where the bulk of the deposits are, then get your money into one of these online accounts that's paying well over 1%. That's an easy way to lift your interest earnings 10 or 15-fold without having to take any risk and with very little effort.
Okay, switching gears again, and before we get into mortgages and refinancing, just if you have a question, please remember to put it in the Q&A section, not the chat. I have the Q&A window pulled up, so I'll see it there. So please put your questions there. Greg, looking at home buying and those who already have a home and maybe looking to take advantage of low rates through a refi, what's the current landscape for those people? What is that process going to look like?
Well, the good news is mortgage rates are near record lows. We're seeing some of the lowest rates we've ever seen before, and they seem to be getting lower. So that's good news. And the other thing is, with the poor outlook for the economy, the likelihood is that rates are not going to go zooming higher anytime soon. So you have this extended window, I think, for a refinancing opportunity for those that are currently own a home, and for those that are looking to buy a home. Again, rates are going to stay low. So just because there may be slim pickings in terms of the supply of available homes for sale on the market now, or it's tough to go, you can't go see your property, you got to look at it virtually online. And look, as things open back up, we're in an environment where rates are going to stay low. So I think for the well-positioned and well-qualified buyer, mortgage rates definitely going to be a nice tailwind at your back in 2020.
Okay, and James, who is viewing, writes a question. You mentioned the window of rates that are going to be low for a while. Is it a good time to refi now, or is it better to wait and hopefully see if rates trend a little bit lower?
Traditionally, when this question comes up, the answer is go, 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 run, do it now, because rates are volatile and they can move against you, and that savings opportunity can go poof in an instant. But I don't think that's the case now. I mentioned the poor economic outlook that's really going to keep rates low for a while. The other thing is, a lot of lenders are still working through a backlog of applications that, from when rates first dropped in the March, April timeframe. So as they free up some capacity, they're going to be back in the market looking for business with very attractive rates. So I don't think this is something you have to run and do today. But it is something that, maybe put it on your summer to-do list, particularly if, there's not a whole lot to do outside.
Sad but true. So one of the most important things we talk about at Bankrate when you're getting a mortgage or looking to refi is shopping around and comparing offers. Why is it more important now than ever to do that?
I mentioned rates being near record lows, but the other thing we're seeing is just a tremendous disparity in rates. Not everybody charges the same rate. Some of those lenders that have really been inundated with applications, they're purposely posting higher rates, just almost as a deterrent for more applications. So the whole benefit of shopping around is not only to see what's available, but also to give you the context so that hey, am I being offered a good deal here or not? So yes, by all means, shop around. That's how you're going to find out if you're getting a good deal. And that's where you're going to find out what are the good deals, which has, I think, a bigger advantage now than we've ever seen pretty much before, just given the wider than usual disparity in rates.
So looking at the reader or viewer questions, one person writes in, since refinances take 30 to 45 days to close, should we be starting the process now, or should we be considering the option of rate lock or playing the waiting game?
This is one where I think you've got to plan ahead. And then by plan ahead, I mean, do the things like check your credit reports, make sure everything's accurate. And if there's any inaccuracies, get that fixed before you apply. Make sure you've got your paperwork together, your pay stubs, your W-2s, your tax returns, your bank statements, all that stuff. Have it ready to go, because that way when you submit the application, you can upload that stuff very, very quickly. That process can go quicker, particularly if it's the borrower who's ready. With lenders being inundated the way they are, you don't want to be the one holding up that process. So I think that's really a premium. And in terms of the rate lock, it's again, I think it because of the processing time, I think you've got to kind of get in this a little bit and kind of see what your timetable is before you lock the rate, because if the lock rate expires, the cost of extending that is not cheap. So again, I don't think that you necessarily need to lock on day one, but you want to kind of gauge, how's it proceeding? What's that look like in terms of closing timetable? And in some cases, lenders have gotten to the point where they won't let people lock until they get the clear to close. So that kind of solves that problem for you, but you got to get downstream to get to that point.
And we've gotten a few questions about home prices. Greg, what do you think? Are they stable or dropping for real estate and housing prices?
Well, it's ultimately going to depend on the market. As the old saying goes, real estate is local. And that's very, very true. I think generally, on the national scale, values are going to be pretty stable. This is not 2008 where you had a bunch of crazy loans that should have never been made, and it pushed values way up beyond, what anybody could truly afford, and you saw prices come crashing down. That's not the case this time around. That being said, there is going to be some softness in some markets, particularly as the supply-demand dynamic gets out of whack. Areas that are being hard hit by employer layoffs, for example, I think are more prone to a drop in prices. And then, the markets where affordability has really been out of reach for most people, that's only going to get worse with unemployment on the rise. So I think those two are markets that may be more susceptible to a price pullback.
Another viewer writes in, is this a good time for retired people to pay off their mortgage?
Well, when you look at the alternative rates of return, the idea of paying off a mortgage that's at, say, 3.5%, that's like earning a fixed guaranteed return of 3.5% on your money, which in this environment is extremely attractive, particularly when you look at it on a risk-free basis. I guess the only thing I would caution there against is don't compromise your financial flexibility in order to do so. You're having to cash out other investments to raise the cash to pay off the mortgage. Think twice. If you're having to deplete the emergency fund or other income generating investments in order to pay off that mortgage, I think you want to think long and hard about that. Money in the bank will pay the bills, but home equity will not.
Very true. Another question, this one on foreclosures. And I know we've seen some of the government response has been to kind of stymie the impact of potential foreclosures. Do you see more foreclosures happening like 6 to 8 months from now?
I think it's probably going to be longer than that because of the widespread prevalence of the forbearance programs. But let's not make any mistake. There's going to be elevated unemployment that's going to be with us for years. And there is going to be a lot of economic and financial hardship as a result of this. I mean, we're still going to be feeling it a year from now. Long after the virus is in the rearview mirror, we're still going to be contending with higher unemployment, people that are behind on bills, those kind of things. We are going to see more consumer bankruptcies. We are going to see more foreclosures. We are going to see more business failures. But in terms of, like the mortgage, the foreclosures, for example, I think the forbearance maybe pushes that down the road a little bit, but it does not alleviate it altogether.
Okay, another viewer question. What's your advice on buying a new home? And I'm sure the COVID-19 situation, has impacted the whole home buying process as well. What are your thoughts, Greg?
You cut out just a little bit there, or at least on my end of the first part of it. The question was about buying a new home? Yeah.
What is your advice on buying a new home?
I don't know that the advice is any different now than it is any other time. I mean, buying a house is like getting married. You got to be financially prepared, and you got to be in it for the long haul. And that really doesn't change. So, if buying a home is still consistent with your goals, with your lifestyle, you've piled up savings, you've paid down debt, your credit's in good shape, I think the backdrop is going to be very favorable coming out of this, in the sense that mortgage rates are going to be very low, and you may have some sellers that are a little bit more desperate to sell. The big thing that's really kind of held up home buyers the past couple of years has just been the supply of available homes has been very limited. And it remains to be seen, if coming out of the pandemic, if that comes back into balance more or not. That is an unanswered question.
Okay, Greg, we've wrapped up the home buying portion. We have a lot of reader questions or viewer questions, so I'm going to try to get to some of these. First one from Bonnie. She asks, I'm considering moving my investments to a RoboAdvisor. I'm about 75 invested in bonds, 20% in stocks. What should be my considerations looking at a RoboAdvisor?
I think, robo-advisors are certainly, the wave that a lot of the bigger brokerages are now moving as well to compete with that. So, I think the big drawback there is the technology platform going to be up to snuff when markets are in turmoil? We've seen some instances where they haven't. And secondly, there's not going to be anybody there to hold your hand when you need it. And if that's something you value, maybe you want to stick with, a traditional online brokerage, many of which are also debuting their own sort of robo-advisor platforms, and some that may even come with personal financial assistance.
Daryl's question, I'm 10 years out from retirement and my account is automatically set for 2030. What's your advice regarding recovery in the stock market in the next few years?
Well, first of all, I think you've got the right allocation. You've got the right target. You've got your time horizon and your investments lined up. Look, we're going to have some volatility in the short term, but I do feel 10 years from now, we're going to have seen the economy rebound. The market will have gone on to set new highs. And so, maintaining that long-term perspective, I think that's certainly consistent with, that long-term time horizon. We are going to have some volatility in the meantime. This may not be the only recession we see in the next 10 years either. So, markets go up, markets go down, but they go up more than they go down. And over a 10-year time horizon, I like your odds.
A couple similar questions here from Danny and Tom. Both note that CD and savings rates have been on the decline since the Fed cut rates to zero. Is there a better alternative for savings to still get a competitive APY and also kind of keep it somewhat safe?
Well, for those that are dependent upon income, I think it's important to know that you should generate income throughout your portfolio, not just on the cash investments. And this is a good example of why, right? Because when interest rates go down, it really undercuts the interest earnings that you would otherwise have. But if you're also garnering income from other areas of your portfolio, your bonds, dividend-paying stocks, preferred stocks, real estate investment trusts, it helps balance that out, as a lot of those dividend streams tend to grow over time. So for those that are income dependent, that's what I would say. The other thing is just that one of the things about a slowing economy, the playbook is cutting interest rates to disincentivize saving and incentivize borrowing and spending. That's the playbook that we're under right now. So unfortunately, every time the economy's in a bad spot, it's the savers that get thrown under the bus.
Another question, what sectors are performing low now and have the potential to rise back in the next few years for potential investment? Is that something people should be looking at, or do you recommend investors kind of just buy the entire market?
Yeah, I'm not in favor of individual investors chasing individual stocks. Rather than trying to find the needle in the haystack, just buy the whole haystack. Buy a total market index fund. Invest regularly. You keep your investment costs low that way. That's really the way that most people should go. To buy individual stocks requires being very hands-on and a lot of learning. And even then, there's no guarantees.
Ivy asks, how should we deal with high rate credit cards?
Yeah, I mean, if your credit has improved, now's a great time to transfer the balance away to something that is a much lower rate that can accelerate your debt repayment as well. Unfortunately, if your credit's in bad shape, this is an environment where you're not going to have the alternatives that you might have had a few months back. Credit card issuers are really tightening the reins, tightening credit. They're not looking to bring on more risk. They're looking to limit the risk that they have.
Interesting question from Terry. Are negative interest rates being considered, and how would that impact savings?
Yeah, negative interest rates, they get a lot of headlines, and, on the surface, it sounds fun. Like, ooh, somebody's going to pay me to take a mortgage. It's not going to happen. Okay. I think we'll eventually see negative interest rates here. That's a matter of when, not if. Treasury yields will go negative at some point. The Fed, I think, will very likely take policy rates negative at some point, but that's not going to filter down to the consumer level. Nobody's going to pay you to take a loan. And you're not going to have negative interest rates. You're not going to pay to put your money in savings at the bank. Rates will go lower, but the negative interest rate aspect won't filter through to consumers. Europe, for example, has had negative interest rates for years, and it's mainly just impacts large institutional funds, and not the individual consumer.
So we talked about FDIC and credit union insurance earlier. Robin has a question following up on that. How can you be sure a bank is safe? Like, is there a place where you can find a bank's safety rating?
Well, the FDIC website, for example, has a lot of the call report data that banks are required to file. And that's the data that is used to really assess their financial health. So if you really want to take a look under the hood, and particularly if you're a numbers geek like me, that would be a good place to look. But otherwise, just the fact that a bank is federally insured, your money's safe. And at that point, any failure is the bank's problem, not your problem. And oftentimes when there's a bank failure, the way you find out is your money's already been acquired by another stronger bank, and you're now a customer of that bank. So you don't even lose access to the money. You just wake up one morning and find out that, surprise, you're now a customer of, XYZ bank instead of ABC bank.
Another viewer asked if you can talk a little bit more about the W-shaped recovery. What's kind of the rationale behind that potential recovery?
Yeah, sure. So in contrast to past recessions, where literally it's less than 10% of people would, when they file for unemployment, they list themselves as just being temporarily laid off and that they're prone to be called back. This time, we're seeing that well over 50%, and in some cases, even 80% of people that are losing their jobs are saying, it's just, I'm just being laid off temporarily. They're going to call me back. And so that is promising, right? As the economy reopens, we can see people called back. I've got two kids that both got called back, right? So, yes, that's kind of, we have the sharp drop, and then we kind of get this, mini spike back up as people get called back, as economies reopen, people start to spend money. But that, to me, is where the rubber meets the road. Because if, for example, restaurants are running at 25% capacity, they only need 25% of the people, right? And so, if business demand is not there, then that's where businesses that may have called people back are going to find that, it turns out we don't need all of you. And then, you start to see layoffs that are not temporary, but are indeed more permanent. That's that second leg down in the W before you get the longer, more sustained recovery.
Got it. This is a great question. I feel like you're the best person to answer anywhere. How does the federal funds rate affect the average person?
The Fed funds rate really affects what is the price of money. And so, think about dropping a rock into a pond and how it ripples out in all directions from there. That's really what the Fed funds rate is. It's the rock dropping into the pond and what ripples out from there, because it determines, for example, the prime rate that banks use when they're setting rates for their best consumer and business loan borrowers. It is that price of money is the basis on which the government and other borrowers have to pay to acquire money. And all other borrowers, consumers, municipalities, businesses, the rate they pay is going to be at a spread above what the government's paying, reflective of the risk that they carry. But that baseline level is very much determined by that price of money that the Federal Reserve sets. And the other one I would add to that is the pricing of a lot of financial assets depends on the level of interest rates. So when the Federal Reserve reduces the price of money, the pricing of financial assets can change, because now what's known as the discount rate, the rate at which you're discounting back future profits, is lower. That can push asset values up, home prices, stocks, those kind of things.
We've got a few questions from viewers who are either for themselves or for someone they know, trying to people who are just starting out and getting into investing. Interesting time to start investing, but like, what would your advice be for someone who is just kind of getting their feet wet?
Well, look, I think it's a great time to do that, right? I mean, it's easy to be interested back on February 19th when the market was at an all-time high, right? The stock market, unlike the mall, is the place where when things go on sale, people tend to run the other direction, right? So I'm very encouraged that people are interested and say, they recognize that what we're experiencing economically, as devastating as it is, that it will pass, that it's not permanent, it's just temporary. And so now's a good time to buy assets at, what could be, prices that look very attractive a few years down the road. So to reiterate what I said earlier about just, buying a total stock market index fund, don't worry about picking individual stocks and trying to pick the needle in the haystack. Most professional investors that pick individual stocks, they underperform the target index against which they're measured. And oh, by the way, they charge a lot more for the service. So rather than try to pick the needle in the haystack and, try to beat professionals at a game even they can't win very well, just buy the whole haystack. Get a low-cost total stock market index fund and feed that account regularly, putting money in on a consistent basis, over time. I think that's a good path to building wealth.
So this question may be challenging to give like a very specific answer to, but just generally speaking, how do credit scores affect rates? So if, let's say, someone, has a okay score, but they're looking to refi, is it, a worthy effort to go and try and improve that score and to get a lower rate?
Yeah, your credit score is really, really important in terms of your ability to borrow money and at what rate, because what that credit score is it is a number that symbolizes your credit worthiness to lenders. And, recall a moment ago when I was talking about how the Fed funds rate affects things in terms of how lenders price the cost of borrowing. It encompasses that baseline level of rates plus a margin for risk. Credit score is that risk measurement in many cases. And so, think of it in terms of auto insurance. Somebody's got a spotless driving record, they're going to have lower insurance premiums than the person who's had 2 accidents and 3 DUIs in the last 6 months, right? And because of the risk. And so it's the same thing with regard to credit scoring as well. Strong credit score indicates lower risk. You're going to get more favorable rates to borrow than somebody who's got a weaker credit score. Is likely to pose higher risk to lenders, in particular at a time like this when the economy is rolling over. Risk is not something that lenders really want to touch with a 10-foot pole.
Let's see, I had the question right here. If you have equity in your home, is now a good time to look into a cash out refi for home improvements?
Well, it depends. From an interest rate perspective, yes, it's attractive. The alternative to that, or the flip side, is the fact that lenders are tightening credit, and cash out refinance has kind of been one of the casualties. In some cases, lenders won't do it. In other cases, they'll do it, but it's going to be a higher rate than if you just did a traditional, what's called rate and term refinancing. And then there are others that are still pricing at the same. So we were talking earlier about the importance of shopping around. I think that's another example of why it's really important to shop around, because for something like cash out refinance, it really runs the gamut. You can have lenders that aren't doing it, lenders that'll do it, but it's going to cost you, and others that are just, it's business as usual in terms of, cash out refinance, provided that you've got a very sufficient equity cushion and proof of income and your debt ratios are in line.
So Dan asks, how are online banks able to offer higher interest rates for savings and CDs? Is it just because they are not brick and mortar? It looks like they're offering 10x what other institutions are offering. So how are they able to do that?
Yeah, I mean, think about it. If you are, let's say, a small bank, with a handful of branches in one particular area, and you're looking to attract deposits, are you going to try to outmarket the big bank down the street that has a branch and an ATM on every corner, billboards all over town, and their name on the stadium? Good luck, right? And so the way that a lot of these banks compete is they're just going to pay a higher rate on deposits, and they can market themselves to a national audience and bring in deposits very effectively that way. It's a lot cheaper for them to pay an extra percentage point on the savings that they're trying to bring in than it is to try to outmarket their competitor who's got very deep pockets.
A few people have asked the difference between a CD from a bank and the CD from a brokerage.
Yeah, the CD from a bank, you're getting it directly from the bank. You know where your money is. It's federally insured, and it's just, you're not going through any kind of middleman. Brokered CDs are where banks are looking to acquire a large block of deposits, and so they may place that with a brokerage who can very quickly raise those funds from their client base. And so, there can be an advantage to that, and that sometimes the rates may be a little bit higher. The downside is, though, that if you need to get out prior to maturity, it often functions differently than with a traditional CD. Traditional CD, where you buy it from the bank, if you need to get out early, you pay your early withdrawal penalty, you take your money, and you move on down the road. With a brokered CD, oftentimes, if you need to get out early, it has to be sold to another investor. And what they're willing to pay for that is going to depend on the level of interest rates. If interest rates have moved against you, that is, interest rates have moved up, you're going to have to take a pretty sizable haircut in order to get them to buy your CD. So for example, you get a CD at 1% now, and then a couple of years down the road, you need to get your money out, but your CD hasn't matured and interest rates are now 2%. Well, who's going to want to buy your 1% CD when there's 2% CDs out there? The price you get is going to have to be cut reflective of the fact that, well, yeah, it's a 1% CD, not a 2% CD.
We've talked a lot about interest rates. George asked, what credit score is good enough for the best interest rates?
It depends on product. Generally speaking, if you have a credit score of 700 or better, you're going to get a very competitive rate. I think that's really the line of demarcation. To get the very best rates, particularly for something like a mortgage, or at times like this where lenders are really squeamish about risk, credit score above 740 oftentimes is a line of demarcation to get the very best rate. So if you're in that boat, there's no worries, you're in good shape. If you're a little bit above 700, getting that score up a little bit may pay some dividends in the form of getting just a slightly better rate the next time you go to get a mortgage.
Kind of bouncing around from topic to topic, but we got a ton of questions in from the viewers, which is awesome. Keep them coming. Another attendee says, if I understand you correctly, it's best to put emergency savings in an FDIC online savings bank than in mutual funds, as the savings is insured and the interest may be greater. Is she understanding correctly?
Yes, exactly right. And that's why I like it, is because the interest earnings are higher and the account's federally insured. And that's not to talk down putting it into money market mutual funds. It's just that the yields are lower. And while they're very safe, they're not federally insured. So if markets really went into turmoil, as we've seen sometimes in the past, some of those money funds can do what's called break the buck. So again, it's not to talk down money funds. I think that's a fine alternative in your brokerage account, for example, for money that you want to put into the market at a moment's notice. But in terms of that rainy day fund, that money that you're going to need there, online savings account is the place to be, and for the reasons cited.
So L. Parker asks about student loan debt. For students who are still dealing with student loan debt, what kind of strategies do you have for repaying that debt off besides just paychecks and kind of using your just the money you have coming in? What other resources are there to help or strategies to get that down faster?
Well, I'll say a couple things. One is that if you're in a position to continue making your student loan payments right now, federal student loans are under a payment forbearance, payment deferral period for till the end of September with no interest, no payment requirements because of the pandemic. But if you're able to continue making payments, you can really make some headway against that balance because there's no interest being charged now, right? So every dollar you throw against it is going towards the principal. So if you're in a position where you're still working, you've got some cash flow that you can put towards your debts, that makes sense that, maybe now's the time to make hay while the sun shines on that. More generally, in terms of student loans, and listen, I've given a lot of presentations to audiences of, young professionals that are just out of college and they got a lot of student loan debt. And that's what they think about when they wake up in the morning, and that's what they think about when they go to bed at night. And, look, don't compromise your overall financial flexibility and your future financial security just obsessing about paying down this one debt, which in often cases is a much lower rate than you're going to pay on other forms of borrowing in life and has much more flexibility. The things like we're seeing with the forbearance option now, payment forgiveness, income-based repayment. Your other borrowings in life will not have that flexibility. So, I tell people, make sure you're contributing to your 401k, make sure you're building up emergency savings. And once you've done that, and pay off your high interest rate credit card debt, you've done all that, then, okay, you want to focus on paying down student loans, go ahead and do that. But to obsess on the student loans to the exclusion of those other things like building emergency savings, saving for retirement, I think is really going to bite you in the long run. Let's think about it. Think down the road 20 years. Do you want to be sitting on a pile of money because you've been putting money away for 20 years in your 401k, or do you want to just be starting to save for retirement at that point?
Good perspective, Greg. Ivy asks, is it a good time to close store credit cards after paying them off?
Pluses and minuses. I think a lot of this depends on what you see when you look in the mirror. And by that, I mean, store credit cards tend to have much higher interest rates. And so if there's a temptation that having that card there you're going to go out and you're going to spend and maybe run up a balance, then yes, do that. Close it out, get rid of it, avoid the temptation. If not, if you're like, whatever, it's not going to tempt me. I can put it away in a drawer and I'm never going to use it. Then I think it's fine to keep it open. And the reason, because when you close out credit cards, it can affect your credit score in a negative way because it makes your debt to available credit ratio look higher. And that's the only thing you want to be cautious of. Again, if it's going to tempt you to spend money you don't have, then that's the big fish you've got to fry, is avoiding that temptation to close out the card. If you're not going to be tempted to overspend, then you can afford to think about like the little nuances of, gee, if I close it out, how's that going to impact my credit score?
All right. Adriana asks, why are lenders not giving the option to refi into a 15-year loan? Is that maybe a specific example that she had gone through, or is that the case where lenders just don't want to refi into a 15-year term?
15-year terms are widely available. I think a lot of this just boils down to the fact that for most people, they can't afford the payment on a 15-year term. Most 30-year fixed rate loan, even on a refinancing, is the dominant choice. And that's just because people need that 30-year repayment period to keep the payments at a manageable level. Refinancing to a 15-year loan is going to be a payment that's 40 or 50% higher. And most people, their budgets can't absorb that. If you're 7 years into a 30-year fixed, and you've got plenty of breathing room in your budget, refinancing into a 15-year fixed is definitely a worthwhile consideration, because you're not necessarily looking for a lower payment, but you are like the idea of knocking off 8 years of mortgage payments. On the other hand, if your budget's, still very tight, maintain flexibility, keep that 30-year. You always have the option of paying ahead. You don't want to lock yourself into a payment that's.
So I know we've touched on negative interest rates. A couple questions specifically of how that would impact savings account rates. It won't. Okay.
Basically, it'll bring savings rates down, but your savings account rates are not going to go negative. And listen, there's 4,000 banks in the country. If one bank goes negative, first of all, nobody's going to want to be first. But if savings rates go negative, what's going to happen to all the money at that bank? It's going to flow out and it's going to go to a bank, one of the other banks that's not negative. And so that's, again, why there's a real hesitation to pass that negative rate on to consumers. And even in markets where rates have been negative for some period of time, it's only been really an impact on large institutional savers and borrowers, not on the consumer.
Got it. Scanning some of the questions to see if we can get some, if there are any kind of that we haven't touched on at this point. A couple questions on HELOC rates, and I think you might have touched on this in the cash out refi question, but I guess what's going on with HELOC rates, and how has that product been impacted by this pandemic?
Well, I've got good news and I've got bad news. The good news is HELOC rates have been coming down because the Federal Reserve was very aggressive in cutting that benchmark Fed funds rate. And so a lot of those home equity lines of credit are pegged to the prime rate. As that's fallen, those rates have come down. That's the good news. Bad news is a lot of lenders right now that, they do not want to bring on more risk by doing more home equity business because in a market where, the economy's rolling over, you're not real sure what's going to happen with home prices. No lender is jumping up and down to be in a second lien position. And so we've seen a lot of lenders either stop taking applications on HELOCs altogether or just setting a very high bar for the applications that they do accept. So in other words, we're limiting it to existing customers, only those that have a credit score above 740, or those that have $100,000 on deposit with the bank, or have their first mortgage with us. You know, it's sort of like the lender's equivalent of social distancing, right? They're not going to bring strangers into the house, and they want to get very comfortable and limit their risk exposure to the people that they are around.
Okay, Greg, I'm going to get us out on this one. So the last question before we wrap up. We'll go back to the bank insurance. Some questions on whether money market accounts are insured as well. And also if you have, is the insurance for one individual or for one account at that institution?
Let's be specific here that we are talking about money market deposit accounts, not money market mutual funds. Money market deposit accounts are bank accounts, just like a savings account. It's kind of a hybrid between a checking and a savings account. And yes, they are federally insured. In money market mutual funds, which are something that's similar in function, but it's entirely different. It's a mutual fund where the return is derived from the investments that are held within the fund. Those are not federally insured. So, but money market deposit accounts are federally insured. And what was the second part of that question, Lance?
So we talked about the money market accounts, and the second part was the 250,000. Does that cover like one account or one depositor? So I guess, can you have?
Yeah, it is per account ownership category. So, for example, Joe and Jane Smith, Joe Smith goes and opens up an individual account. He's insured up to $250,000 total, whether he's got a savings account, a checking and a savings, or 14 different CDs, $250,000 limited to him. Jane can go, she can open up an account, and she is insured up to $250,000 on all the accounts she has in her name, Jane Smith. And whether it's one account or 15 accounts, $250,000. Joe and Jane can go together and open up joint accounts. Now, because it's a joint account, that's insured separately, not the $250,000, $250,000 on each depositor, $500,000. So, one couple can, title things differently in order to lift the deposit insurance coverage while keeping their money at one bank. So again, go back to something we talked about earlier on. There is no reason in the world to expose yourself to the risk of a bank failure by having more money than is covered by federal deposit insurance. There's just so many ways that you can title accounts differently, put money at different banks, even utilize products that banks have where they sort of trade off deposits with other banks to help their high net worth customers maintain deposit insurance on all their money.
Awesome. Well, I appreciate the insight, Greg. Before we wrap up, I wanted to share one exciting announcement. At Bankrate, our mission is to empower people to make smarter financial decisions. As part of that mission, we're thrilled to share with this group first that the reboot of the Bankrate account will be available early next week. So you may be asking, what is a Bankrate account? This is an account where you can log in, and it includes tools like personal article feed, so you can get content relevant to your interest, recommendations for calculators based on your interest, daily rate trends, so you can see where rates are trending on a number of different financial products, and a mailbag feature so you can submit questions to all Bankrate experts, including Greg. So keep an eye out for that next week, and be sure to sign up on the Bankrate homepage. And stay tuned to us here at Bankrate for more coverage on COVID-19 and your money. We're here to give you the content you need, and we appreciate your readership. So we have a hub page on bankrate.com that you can go to now for all your current coronavirus coverage. You can find that at bankrate.com/coronavirus and your money. And if you want to follow us on social media, we're at Bankrate across all social platforms, so you can find us there. Greg, any last thoughts before wrapping up?
Thank you, everybody, for tuning in. Thank you, Lance. Genius work as always. And special thanks to all those behind the scenes that made this happen, Eli and all the others. Thank you all for your efforts in making this happen.
All right. So thanks, everyone, for joining us here for this webinar, and have a great rest of the week.